Having a sole proprietorship means that you and your business are one and the same. There's no separate entity formed, so therefore all assets, including money, your house, and your car, which looks like a turtle, all belong to you and your business. There's no separation here. Because you and your business are one and the same, when money comes into your business and you make a sale, then that money automatically passes on through to you. When it comes to paying taxes, all of that money passes on through to your personal tax return. That income is going to be claimed on your personal tax return. It's then going to be subject to 3 different types of income taxes: federal and state income taxes, as well as what is known as self-employment tax, which equates to 15.3% and covers Medicare and Social Security. This 15.3% applies to your total net income. Let's compare this type of business to a different type called an LLC, a limited liability company. So that money, your house, and your weird turtle car are completely separated and protected from the business's liabilities. Now, in terms of taxation, you have 2 different options of how to be taxed. Option number 1 is the default. When money goes into your business, in order to pay yourself, you simply need to do what is called an owner's draw, transferring money over to your personal bank account from your business bank account. You can also write yourself a check from your business account. This is the default method, and you're going to be taxed again as a pass-through entity. Your LLC is going to be disregarded by the IRS, and that income is going to go onto your personal tax return, and you're going to pay federal, state income taxes, and self-employment tax. Now, option number 2 requires you to file additional paperwork with the IRS and elect S-Corp taxation status. You and your business are still separated, you're still an LLC, but you're going to be required to hire yourself as an employee. This means that in order to pay yourself, you're going to have to issue payroll to yourself. And that comes along with taking out payroll taxes. Payroll taxes are going to include federal and state income tax, as well as FICA, which includes things like Social Security and Medicare taxes. Now, there's a potential for tax savings here because you're required to pay yourself a reasonable salary, but any profits that are left can be transferred over to yourself in the form of distribution. While distributions are taxable income, they are not subject to that 15.3% self-employment tax. This means that you can save yourself that 15.3%, and it can equal a big tax savings. But first, you need to make sure that you are able to hire yourself as an employee, which means you're going to have a payroll system in place. You're going to have to be compliant with your state employment requirements, such as getting workers' comp insurance, and you have to pay yourself a regular, reasonable salary.